which is going to very much impact companies that have taken on high risk in lower interest rate environments, whether that's small. As always, guys, this is not financial advice. This is my opinion. Well, welcome back in, everybody. It's been a minute and life is kind of busy right now, busy in a good way. I know I have a lot of call outs to get through, and when I get more time, I'm going to start dropping more videos on individual stocks, because I think that's where most people gain the most value or actually are entertained here. So today I want to talk about a specific stock that's starting to hit on all cylinders. Haven't done a deep dive in or a fundamental analysis quite yet where I plug in the numbers and get a intrinsic value on the company, but I would say Photronics Inc., ticker symbol PLAB, is definitely on my radar, and I did take a very small position here recently. And when you look at the chart, you can see the volatility here, but we can see the upward trajectory, earnings and revenue growth that this company's had. This is a very small cap company here, sitting right around $2 billion, actually doing nearly $900 million in revenue. And when we look at net income coming in at $120 million and a forward PE sitting just under 14, this stock is definitely on my radar. And I think it's one of those in the right place at the right time type of stocks we've talked about. So when we go on their company website, we can see the company's been around for 50 years, specialize in products delivered world-class performance, and we continue to evolve and support to leading-edge technologies for both integrated circuits and flat panel displays. So when we think about the semiconductors absolutely skyrocketing here, this is a company that could definitely have a tremendous amount of spillover effect and a pretty substantial total addressable market that could lead to unforeseen growth here. And when you're talking about trading at 12, 13 times earnings, that's very cheap for this industry. And obviously it's a small cap unproven company, but they've been around for 50 years and they now are expanding in China. So this one kind of popped on my radar when I was just doing some research here, and definitely have a little bit more work to do on the company, figuring out management. But when I look at revenue growth here, going from $524 million of revenue growth up to $829 million of revenue growth. But I take a look at the last 4 and 5 years here, growing 10, 8, 24, 8%. There's really good top line revenue growth here that fits into when we look at a low multiple and sustainable top line revenue growth pushing close to double digits, price appreciation that we could absolutely see in the very near future, especially if they surprise to the upside, which they recently have done on their last earnings, from $28 a share all the way up to $32 a share, and I believe I bought some around $29.80. So I really took a tiny position, because this is a very volatile stock, as we can see here. Very big price action moves. But with that being said, take a look at the trajectory here. It is heading in a upward direction to the right hand corner of this chart, which is what you like to see. There's really only one person covering the stock, and they got a price target sitting around $21, projected to do right around $938 billion of revenue this year. So we can see that they have foreseeable growth here of roughly 5 to 10% pretty comfortably, I would imagine. When we look at cash and cash equivalents growing from roughly $200 million of cash and cash equivalents to now sitting at $499 million of cash and cash equivalents. Short-term investments sitting at roughly $13 million, which gives us a grand total of $512 million of cash and cash equivalents. So, financially, they got a substantial amount of cash here for a $1 to $2 billion company, with total debt sitting at $24 million. So they can absolutely cover the total debt. And when we look at book value for the company, sitting at $15, $16. This is definitely an interesting company here, ladies and gentlemen. It is trading at a substantial discount to its peers, especially when we look at a forward basis here, trading at 13 times versus its peers 29 times. This is kind of what's led me to stay away from a lot of the semiconductor stocks here. The earnings are not supporting the recent moves that they've had. A lot of perfection is being baked into a lot of these semiconductors. And I'm not actually talking about NVIDIA, believe it or not. NVIDIA has the business rolling up, but I'm talking about, Intel, even Micron. These valuations are getting very rich on earnings that have been pretty disappointing overall. Yes, their guidance is very exciting. Yes, the AI movement is very exciting, but I'd rather buy something that is kind of getting overlooked, that's tremendously undervalued, that the fundamentals are actually supporting the price. And I do think the fundamentals are supporting this stock's price, where when I look at Intel and even Micron, if they disappoint, you're going to see a pretty substantial pullback on those stocks. So trading at 13 times earnings and still growing revenue between 6 to 8%. And this probably needs to be updated because as far as I understood, they raised their guidance. So you're probably looking at closer to 7 to 9% growth rates here in the foreseeable future for this company. So when we look at valuations, when we look at the growth rates, they're outgrowing their peers. Their valuation's way cheaper than their peers. It's kind of just a stock that is a low market cap, high volatility, really hasn't gotten any discovery quite yet that I think of. And so when I look at this could be a pretty big opportunity. You know, this could be a company that can grow into maybe a $5-10 billion market cap here. And when we look at the net income margins sitting at 14%, you know, that's super strong here. Net income margin sitting at 14% while peers are sitting at 2 and 3%. So this is definitely one that I just started scratching the surface on, guys. So when we look at the S&P 500 now, getting close to 5,000, I do think when we get closer and closer to 5,000, we got to be talking about muted returns. So what do I mean by muted returns? Well, if we get close to 5,000, a lot of analyst estimate are projecting between 240 to maybe high end 250 of earnings, which means if we put a 20 multiple on that, we basically have 2024 earnings in the books, because historically a 20 multiple seems pretty normal when everything's fine, when we're in a lower interest rate environment, which we are not, but when we factor in the rate cuts, we could be. So there's a lot of question marks here, definitely for 2024. Number one, first question marks are going to be, where are earnings actually going to come in? Because we are pricing in some serious perfection here. Number two is, where are interest rates going to be to justify a higher multiple on this market? And lastly, is the consumer going to be hanging in there as interest rates now start to normalize and we get the yield curve getting back to normalized levels? So let's start out with valuation. Trading at 24.5 times earnings is extremely rich. You know, we're looking at about a 20 to 25% premium on this market, not factoring in where earnings are actually going to come in and if a consumer slows down. We also have to factor in that the market's pricing in some serious rate cuts here, and well, inflation is still remaining a little stickier than we thought, so that means rates could actually remain elevated for longer. So a couple concerns I'm bringing up here just to recap. Number one is historical valuations are pretty high right now. Number two is a lot of uncertainties when we're looking at the interest rate market. We haven't had to worry about the interest rate market for the last 15 years because rates have been near zero and you could pretty much borrow money for free. Now, I know that the market's been heading up in an upward direction from bottom left to upper right, but the problem with this is as the market gets more and more expensive, we have to think about fundamentals because there is going to be muted returns if we can't grow into these valuations. Now, the overall market is expensive when we look at 24.5 times earnings. If you guys have been following the channel, what I personally focus on is distressed assets or assets getting overlooked, kind of like PLAB. Once I do a little bit more research this weekend, I'll decide if this is going to be a long-term hold, a small position, a larger position, and all of that going forward, which I'll keep you guys in the loop in. But we really have to start pricing in fundamentals at some point in time, which I don't think the market is really looking at. The market's not concerned with fundamentals. The market's concerned with Fed's cutting rates, the AI boom, not missing out, getting FOMO on that. I think there's some excitement about a possible new regime coming in. There's a lot of things to be excited about, no questions. But when we separate our emotions and actually look at what we're buying from a fundamental analysis, I would say that there's a lot of question marks here. And so what you have in front of you right now is the trailing 12-month PE ratio on the S&P 500 here throughout history. You can see here there is a consistency average of a low and a high here within this blue range. And we can see that we are approaching up to the upper echelon of this high. Okay, and I definitely think there will be a blow off top here. We're probably going to hit 5,000 or get pretty darn close to 5,000 before we have any major issues, because that's just kind of where the trajectory is going in this market, and that's where money's moving to. Everybody's getting excited. Interest rates are coming down, which means there's less places to put money. So you're actually forced to go into the market, even though it might be expensive. And this is a dangerous game to be playing here. And so when we zoom in here, we can see that we are getting to what I would consider close to bubble territory. I think anything in this upper echelon and above is definitely bubble territory. And I think anything above a 20 multiple is fairly rich. Now, there would be multiple reasons why I'd be buying above a 20 multiple. If the government started stimulating and we had interest rates coming down, knee-jerk reaction could be that the market pulls back. long-term reaction should be you might want to buy on this because there's a lot more liquidity, people are going to spend more, and earnings are going to follow eventually that stimulus package that gets passed. But that is not the case right now. The case is that there's been a tremendous amount of stimulus passed recently with the CHIPS Act, the IRA Act, and the fact that the government doesn't really have a debt ceiling really over the last few months. And what have they been doing? They've been spending like drunken sailors, and look at what happens. We follow on the multiple on the S&P 500, specifically your tech stocks and the triple Qs have been what's been leading this market. Underneath, we've found tremendous value that has outperformed. I'm talking about buying companies like Verizon at $30 a share that are now up 35-40% with an 8% dividend. You're talking about almost a 50% rate of return in a 1 year window. And we talked about Raytheon Technologies. We talked about CVS on the big dip that it had. Now, CVS has kind of been volatile as well, but these are companies that really haven't participated in the massive rally. And to me, we can consider them kind of distressed assets left for dead, but they still have some value here and they can still surprise with earnings growth or earnings stability when we think about a slowing economy. I think you really have to tailor expectations and factor in muted returns. It can play out many different ways. First way, we could obviously say that there's going to be a correction and that we could trade sideways for an extended period of time until valuations make sense again. That could definitely happen. The second way could be that we have a blow off top. I'm completely wrong. And returns are going to be astronomical because people are just not going to care. There's a massive amount of excitement and liquidity in the market, which is absolutely on the table because there's over $6 trillion still in money market accounts sitting on the sidelines. So we could have that blow off top. But lastly could be that we actually do get a pretty substantial market pullback in the form of, talks of recession and or yields starting to normalize and the clock ticking, which we've talked about, the 2s to 10s. Take a look at where we are now. When we take a look at the 2s to 10s, guys, we're starting to get a normalized level. And, we've kind of talked through the 2s to 10s for a little while here. It's not the inversion we were ever concerned about. As you guys know, I was actually bullish going into the end of the year while the market was still inverted. But now that we're getting the uninversion, one-sided bullishness is actually making me a little bit more skeptical and bearishness when we look at historical returns at these valuations, when we look at the yield curve now uninverting and what normally happens when yield curves uninvert, especially as steep as they went. Take a look. We obviously go through recession every time that yields start to normalize, right? Then we have to factor in the real estate debacle that's still going to take place this year into 2025. And that's going to be the amount of refinancing we have to do for commercial real estate at higher rates, which is going to impact net cash flows for a lot of these companies. So capital expenditures are going up, whether that's small cap companies unprofitable, whether that's real estate companies that really didn't build enough cash flow within their models. So these are things that still have to come to fruition, and we definitely could have some sort of liquidity crunch here when we factor in the consumer running out of spending power, the amount of debt that they're piling up here. Government spending could be slowing down because, we've had a tremendous amount of spending, and that's definitely becoming a concern when we look at how much the government's spending on the interest on the debt, right? The interest on government spending is astronomically high. It's going to be a top 4 concern when we look at the overall congressional budget. So when we think about the budget, Social Security, defense spending, right up to those two is going to be the cost of our debt, which is extremely disgusting when you really think about it. Your major expenses in your household should never be your credit card debt as your number 2 or 3 thing. The high interest debt that really doesn't support anything. That's what the government spending is right now, okay? Their biggest bill right now is going to be their credit card debt because they have been fiscally irresponsible with taxpayers' money. And unfortunately, we're probably going to be the ones that suffer. So we are getting, first and foremost, we are still in a bullish trend here. We're getting a substantial breakout of new highs. So you'd never really want to bet against that because that's very dangerous to do. Anytime a company's making all-time highs, get the hell out of the way. I think when we think about NVIDIA breaking out of 500, now trading over $600 a share, that's a great example of what a breakout looks like. Money flow starts coming in, euphoria starts taking place, you have algorithmic trading taking place, trying to capture some of the percentage gains that could happen in a breakout. So there's many different things that trigger these types of breakouts. So always be cautious on a breakout if you're trying to go short. But here's what I would say. we're breaking out to new highs, but we're having a hard time really getting a true breakout because this rally is starting to run out of some steam here. Okay, when we look at extreme readings, it's starting to hit some extreme readings. Now, if it consolidates at these levels and we start to see things cool off and normalize, we could absolutely keep going higher. So I want to walk you through this here. Number one is I do think we're in a topping process. Okay, I do think that there's going to be more money coming in here and we're probably going to hit some newer highs. But I still have a high risk period coming out in March timeframe. Okay, about mid-March is where I'm starting to think we need to start taking some chips off the table. Okay, that's from a charting perspective where I would, if I wasn't looking strictly at the fundamentals, I would say that mid-March could be an interesting time frame here, especially if we start seeing it get rejected from these levels in the very near future. If we start seeing the S&P 500 start to kind of cool off, sell off a little bit, and we're starting to head into March and we're getting curling over. We get the curling over down here. We start breaking beneath this trend line that we broke out of. And I would be concerned a little bit at these levels, okay? Especially when we talk about valuation once again. We're in pretty pretty high valuations, I would say, overall. Now, individual stocks, not so much, but specifically the top 10 to 15 names that have carried this whole market are expensive. But we don't have confirmation quite yet. What we want to start see is the TTM rolling over here, and we want to start seeing the RSI and money flow coming down. Take a look at money flow exploding into this market. That is what I would consider FOMO, guys. When you get a V-shaped type of money flow into this market like that, this hasn't been driven off of ridiculously great earnings or stimulus packages, which eventually will go to corporate earnings. This has really been driven off of a few different things here. It's been driven off of the Feds, and it's been driven off of the AI movement, as we know, the 15 names that have kind of gotten expensive and carried most of this market. But I definitely think we are getting to extreme readings on a lot of levels here. So as you guys can see, there are a few things that I'm kind of keeping an eye out, where my mentality is going, and the kind of the thing that's going to put this all together, the glue that sticks this all together, to me, is going to be watching unemployment. You know, I think unemployment is going to be kind of the domino that triggers everything. So we know about the inverted yield curve that is starting to normalize, and that's going to take time before we normally get recession. But what's going to be the domino that triggers everything? I think personally it's going to be unemployment. It seems that even if we have negative quarters of GDP, they're not going to declare that we're in a recession. So the only other thing that could possibly kind of poke a hole in this thesis or poke a hole in this bull market, I think, is going to be unemployment. The minute unemployment gets out of control or we start seeing a big tick up, I think that's going to send alarm signals across many sectors and kind of change the mentality of the investor going from bullish to bearish. And actually, that would be what causes, I believe, the market to turn around. Now, is this going to happen in March? I'm not 100% sure what the trigger is in March. I am going to keep an eye on kind of if we start to see the market weaken into March, that's definitely going to make me more and more bearish. Now, if we get a consolidation through March, obviously I'm going to be neutral. If the market just keeps going up here, you know, really don't know what to say other than valuations are just getting ridiculous. But I think I've shown you that historically you want to be looking to possibly take profits when we're talking about the valuation that we're sitting at, especially with a lot of question marks with the consumer earnings and where true yields are going to be. So as always, really appreciate your time. Thank you so much for spending it with me, and we will see you in the next one.